since late 2022, beginning of 2023, they've kind of stabilized. And a lot of people think they're going to go back down because we're going to have a recession, right? And the economy is going to slow down. But here we are. Japan just had a negative GDP growth, and their yields are going up. So I think they're the canary in the coal mine. And poor Rachel Reeves, it might not be her fault for gilt yields rising even more. Tuesday, November 18th, 2025, Maneco 64, Homo Alternative Economics, and Contrarian Views. Well, things are getting interesting from all angles. Today, we're going to talk about Japan and the Japanese government bond market. The Japanese treasuries are known as JGBs. I used to trade JGB futures back in the day. They were a nightmare. I'll tell you about it later. But suffice it to say, I've been covering Japan since I started this channel, really, almost right off the bat 10 years ago. And why is that? Well, because under Prime Minister Abe in 2013, and even before that, Japan was a pioneer in the creation of currency and credit out of thin air. Debt, right? You might want to call it money printing, QE. And the reason it did that is because it never allowed the real estate and stock market bubble of the 80s to really flush out of the system. They kept bailing the zombie banks out. They kept doing public projects, fiscal spending, and it became a nightmare. And unfortunately, that's the way I feel we're going in the West, in the US, in the UK, and Europe. But what's happening now might put an end to all that. We could be in the eye of the storm here. We could be in the bond apocalypse. We could have a festive or Christmas bond crisis, which would be unusual, I think. Bond crises usually happen in the fall or autumn during the equinox, but this could be kicking off because one of the reasons central bankers were so confident in doing a lot of QE is because they thought there was a deflation problem, that prices would go down. People like Bernanke, people like, all central bankers really in the West. And they thought that by printing, reserves or money out of thin air and lifting the size of their balance sheets, increasing the national debt, pumping this funny money into the economy and the markets would never be a problem, because they thought bond yields, government bond yields would never rise. But I've got a message for him. It's called a bear market. And back towards the end of the previous decade, in 2019, beginning of 2020, I was warning that I thought the bull market in bonds that we'd had since the early 80s was about to end. It'd been a 40-year party, and it has. And in 2022, that was the worst year for bonds and stocks. They both went down together. But in the last 3 years or so, things have stabilized. Bond yields have remained quite steady. But now it looks like the Japanese government bond yields are starting to take off, and we're going to look at that today. Before I do, just like to give a shout out to my precious metals dealer affiliates. Miles Franklin in the US. I have a link below in the description for a landing page. The best thing to do, though, is to call them on a toll-free number if you're thinking about adding to your gold and silver stack, or you're thinking of doing it for the first time. I think now is probably a good time because the market's taken a breather for the last month. And I can tell you that this coming crisis, and I think it's beginning, this bond crisis, is the failure of the fiat currency system. And I say that not in exaggeration, but because the other side of the bond market is things like the currency, the currency that we use. It also backs a lot of the asset side of banks, and banks are going to be in trouble when these government bond prices continue to drop. Yields, of course, are rising. When yields rise, prices drop. But yes, I think it's more important than ever to have gold and silver. And here in the UK, my affiliate, I've been dealing with them on a personal basis since '02. They've been around since 1981. It's Gold Investments. There's a link below in the description to how to get in touch with them. You can use their website. You can go there as well to visit them in London. Get your gold or silver from them. Have them ship, whatever you want. And by the way, today I'm going to London to see them because some of you have been nice enough to send some things, some gifts to me through them. I don't have a P.O. box. And I'm just going to go for a chat with them. I go at least once a month. Anyway, back to Japan. As I said, I've been warning about Japan for, almost a decade. I even have a playlist called the Japanese yen carry trade. I suggest you go there, and there's plenty of videos there explaining what the carry trade is. But suffice it to say, and I'll try to be really brief, the Japanese kept interest rates very low for a very long time, even negative, and they're still really low, the short-term rates. And what that encouraged was foreigners to borrow in yen so they could take those proceeds in dollars, pounds, or euros and buy high-yielding assets. That's how they leveraged. The other thing that the yen carry trade needed was a weaker yen, which we still have now, because when you borrow in yen, you want the yen to go down in value because the debt becomes more manageable. But so right now, a lot of the Japanese investors, the big life insurers, pension funds, Mrs. Watanabe, they have invested outside Japan because in the past, government bonds from outside Japan yielded a lot more. I mean, up until 2 years ago, the 10-year JGB was at 0 or 10 basis points. But now, with bond yields in Japan rising, they're going to think twice about putting money abroad. That's going to be less demand for our government bonds. And also, yes, it's going to be harder and harder for foreigners to borrow in yen. They might have to close some of their carry trades. That means they'll have to sell their high-yielding assets, riskier assets. And you can see that the Japanese are, the government and the ruling coalition, they're worried because yesterday you had a negative GDP number, and this was the first time in 6 quarters. So Japan's real gross domestic product shrank by 1.8% on an annualized basis in the 3 months through September. So their CPI or inflation is running at like 3-4%. So they don't have deflation. That was a ruse by the central banks to pretend that printing money didn't matter. And it's the same ruse they're playing with us here in the UK and the US. So what's Japan doing because of this falling GDP? Well, it's going to be the perfect excuse, and this has come out today now. Japan ruling party bloc pushes for big jump in extra budget. So it looks like, and this is from Bloomberg again, it says the Responsible and Expansionary Fiscal Policy Caucus called for an extra budget worth 25 trillion yen, $161 billion. That's huge for an economy the size of Japan. It just goes to show that, and I've been telling you this for years, they're going to keep inflating. They can't stop. But now markets seem to be a bit worried because instead of buying JGBs, they're selling it. And for example, the 10-year JGB this morning is trading, it traded up as high as 1.78%. Doesn't seem that much. But as I said, until a few years ago, and I'll tell you when, until the beginning of 2022, it was less than 10 basis points, and here we are approaching 2%. I'll tell you in terms of the last time it was here was back in 2008, so it's a 17-year high. And the thing about the other government bonds, like in the UK, Europe, and the US, is that yes, we've seen the same kind of move since 2022. Bond prices have collapsed. Bond yields have gone up. But here in Europe, since late 2022, beginning of 2023, they've kind of stabilized. And a lot of people think they're going to go back down because we're going to have a recession, right? And the economy is going to slow down. But here we are. Japan just had a negative GDP growth. And their yields are going up. So I think they're the canary in the coal mine. And poor Rachel Reeves, it might not be her fault for gilt yields rising even more. It could come from the Far East, right? From Asia, this bond problem, even though she hasn't done a very good job either. So, for example, today, let's have a look what the JGB yields are doing in terms of, the 10-year yield is up a couple of basis points. It got up to 178. The 30-year is up 6 basis points, which is quite a lot. It's at 330. The 40-year is approaching 4%. It's at 367, up 6 basis points. Right now, actually, UK government bond yields or the gilt yields are pretty steady, and so is the US Treasury yield curve. But I'd keep an eye on them. I don't think this is over by any stretch of the imagination, and I think it's going to spill over also into the stock market because this carry trade provided liquidity to the global financial system because of a cheap yen. And the other thing that Japan is showing us is that this idea that a recession would be positive for bonds, that's a pipe dream. That's something that used to happen during the bull market that we had since the early 80s and especially since the '08 crisis. So now we're into a stagflationary environment because, Japan has, if we see another quarter of GDP shrinking in Japan, they'll be in a recession. And let's get some numbers out of Japan, economic numbers. So let's look at prices. Well, as I said, their inflation rate, or CPI, which is the more appropriate name for it, is at 2.9%. It rose from 2.7 in August, so it's not going down because there's a recession. And in the last year, the lowest rate has been 2.3, and it's been as high as 3.7. So I'd say the average CPI in Japan in the last year has been 3%. So Japanese investors are getting fleeced. The debt situation, of course, in Japan is not very good. I think, let's have a look here. Government debt to GDP is at 240% right now. So yeah, I think bond prices are key right now, and they could really, they're already affecting, I think, the stock market all over the world. We've seen, the NASDAQ 100, the Dow, the S&P starting to keel over. So we need to keep an eye on that, and that's all due to the government bond market. I really want to emphasize how important government bonds are in the period of, you want to call it the Great Moderation, from the early 80s to 2020, when the 10-year yield dropped to 0.3 US one. Things could be fixed quite easily. You started QE again, you cut rates, and everything was honky-dory. But now, in a bear market, things are totally different. Recessions don't necessarily mean that central banks will be able to cut rates aggressively, even if they could do QE, of course, and I think Japan will do QE. US is almost back to doing QE, but it's going to be a mess because, that Great Moderation is ending, and all it means is that bond prices bond yields are going to keep rising. Yes, they kind of stabilized the last few years, but that was just a false signal. It was just a consolidation. They're going to go back up. Prices are going to go down. It's going to put pressure not just on banks. It's going to put pressure on insurance companies, pension funds. It's a huge mess. And that's why you want to have real things, because we're seeing the unraveling of the paper game, the unraveling of financialization. And Japan is the poster child for that. It was the poster child for QE as well. So there you go. That's what's happening this morning. I wish I had better news, but it's what's happening out there. And if you have physical gold and silver, if you're exposed to the gold and silver miners, you shouldn't be worried. And you should be worried, though, if you have a lot of government bonds, if you're dependent on a pension fund, if you're dependent on the government, yes, then you should be worried. But if you've been able to become more of a sovereign individual, to have stuff outside the system, then this will probably actually be a huge opportunity for you. So let's quickly look at the markets. It's 8:32 a.m. I'm a little later today, which is good, really, because Rudy and I had been getting up too early. Spot gold, believe it or not, traded below 4,000 just before we went for a walk this morning. Now it's at 4,029, down 16. High's been 56, and the low's been 39.97. Even silver has recovered from the dead. It got down to 49.34. Well, that's all relative, right? The dead. It's now just above 50. And the stock market continued to drift lower. We're seeing the Dow down 0.33%. NASDAQ 100 down 1/3 as well. And the S&P 500 down 1/3. And with that, I'm going to wish you all a very good day. Take care. Bye.